Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 114. And in this week's episode, we're going to be focusing in on diversification. Should you diversify, and also a few different ways to diversify. Diversification, in simple terms, is just a way to spread out your risk. So when it comes to diversification, it all comes down to hedging. Right? And if you don't understand what hedging is all about, it's really just looking at your risks or the positions that you have and minimizing those risks. So if you have all your positions all going to the upside, hedging or diversifying those things could help in case you get a large market pullback, because not every position would go down the same rate or the same way. Some positions may go up, some positions may go down with the market. And that's what diversification really helps you out with. So the big picture and the big goal behind diversification is to minimize the risk. Okay, now there's some traditional ways to look at diversification, but I'm going to share with you some other variations and other ways to look at diversifications at how to minimize those risks. So in the back of your mind, as we go through this lesson, keep in mind that we're really honing in and focusing on the risk management part for diversification. It's not just to diversify because it makes you feel good. It really comes down to looking at diversification, and in case you get a market pullback and you're invested fully to the upside, you're diversified or hedged, so that way you minimize the risks, right? It's not about just feeling good or having a red car versus a blue car because the blue car makes you feel good. So in diversification, there's really just a point to minimize the risks. So as we look at the different ways to diversify, okay, so the methods of diversification, you have a position-based diversification, which we will cover all of these here in a minute. But to give you a rundown, there's a position-based diversification, which is most common. Then you also have an inverse position. So for example, like a GLD and a SPY position. You have a time-based diversification, which could be based on the same stock. You have an ETF-based diversification, like the SPY, IWM, which is a basket of stocks. You have a stock and option mix strategy, which means you could be selling calls on the upside of your stock position to diversify or hedge that position. Option strikes, so you can mix and match some option strikes, calls and puts even. And then just mixing in option strategies if you're in the option business. So let me go through a few of these different variations just to show you how to diversify and how to see your positions by hedging these positions. Now, before we get started and moving into these examples, keep in mind these are just examples. They're not recommendations to buy or sell any stock or security. There's some risks involved, especially tax consequences. So, of course, contact your financial advisor or your personal investment professional before making or placing any trades. Okay, so here I have my Think or Swim panel and platform up. So the first type of diversification that I want to share with you is just a simple position diversification. And since we are on live market hours, I will go ahead and just share with you how to go ahead and just do a simple basic diversification on positions. So this is what most people think of when it comes to diversification. So if I buy Amazon, we'll just go lightly here. Let's say I have 10 shares of Amazon. I'll go ahead, we'll do a market order for this one. I'll go ahead, confirm and send that in. You can see here in our Play account that we have, it's going to cost me about $7,000 for those 10 shares. I'll put those in. And now, as you see, I should have those 10 shares in Amazon. So now the problem with this is if Amazon tanks and goes down, you're losing your full investment right there. You're losing your $7,000 or whatever that you put in on the stock because you only have one stock, you only have one position. So diversification, ultimately, if you have another company, something, let's say a little bit differently, ExxonMobil, if I go ahead and buy this, and let's just say I go ahead and do, since this stock is a little bit cheaper, let's just say I do 20 shares or 30 shares of this one, and I'll go ahead and buy this one. So now all of a sudden I'm filled on both of these orders, and now I have Amazon and ExxonMobil. So as you can see right here, between both of these, I'm diversified that if Amazon goes down, but ExxonMobil is a little more stable. Let's just say there's somebody who tweets out something, maybe there's a political issue regarding companies or a certain type of tech companies, then all of a sudden, at least my ExxonMobil position helps compensate for that, right? And the same thing in reverse. So if, let's just say, something happens in the oil mining, oil companies where they can't drill anymore or things like that, or there's just a bigger tax, whatever the cause is or whatever the relation is, it spooks the market, then at least I have my Amazon position to counterbalance that, you see. So it's kind of like a 50-50 split diversification. Now, you'll notice it's a 30 share here and a 10 share here, but Amazon, of course, is higher price. So you could say it's slightly balanced. In either case, you could continue and stack a third position on it if you wish, but that's a whole different game. So in general, this is what most people think of when it comes to diversification. Now, the next kind of diversification, and let me just readjust this account right here. We'll just reset all balances to 0. Yes, and you'll still see these positions here simply because they have to clear out the next day. But we'll talk about the next part of the diversification, which is inverse positions. So let's just say, for example, again, we go ahead and let's do something like the SPY or the Dow Jones. Okay, so SPY is the spider, so I'll go ahead and buy some of these shares, and I'll just do, let's just say again, another 10 shares right here. Confirm and send that in. So there we go, we got filled. So now you can see right there, we have 10 shares of the spiders. Okay, we don't have anything else. Those are Amazon and ExxonMobil are zeroed out. So right now we just basically have the spiders. So typically when the market goes up, the spiders also go up. Okay, the spiders is the S&P 500. It's the ETF for it. Now in inverse or contrary to this, when the market typically goes up, gold typically goes down. Okay, and on the flip side, when gold goes up, typically the market goes down. Now you could do the same thing with TLT, like the bonds, or you could do something with the gold. So what I could do to diversify this based on our inverse strategy, okay, so this is strategy number 2, is we're looking at the SPY, and now what I could do is go into the TLT, and I could buy the TLT, okay, and I could hedge it this way, okay, just in case, and I could say, okay, let's do 15 shares so you could see just a different position on there. Okay, so now I have 15 shares, and now I have 15 shares of TLT and 10 shares of SPY. Now, typically these move inverse or opposite. It's not always the case. It's not always going to happen in that way. Sometimes when the market goes higher, bonds can also move higher. Sometimes when the market goes higher, the dollar or also the GLD or gold can also move higher. But in general, most of the time they should work a little bit opposite, especially if you get a massive pullback or massive selling or a massive pop. So that's one way to do it. You could also do the same thing with the GLD. If I buy this, and we'll do something that's a little bit, let's just say 20 shares here on this one, just again, a little bit different. And we got filled right there. Again, so we got 20 shares of gold, 10 shares or 15 shares of TLT, and we have 10 shares of SPY. So if you look at these, you could see now I'm diversifying, not the Amazon and ExxonMobil, but now I'm diversifying right here based on inverse positions. Okay, so these are opposite of what I normally am looking to move for the SPY. And you could do this maybe just slightly on the gold and maybe just slightly on the TLT, or you could just have one position on the TLT or the gold and a lot larger. So for example, you could have 100 shares on the SPY and only hedge or diversify maybe 20 shares on the TLT or the gold. So again, it just depends on how much risk level and how much hedging you want to do for your diversification. So looking at these two, we did the position, we did the inverse. Let's look at the time-based change in diversification and hedging. And then we'll also look at the ETF, which is the single position, which we've kind of already been covering. All right, so let me reset this again to 0 and reset these balances. And here, what I could do is to cover a few of these right here. A time-based diversification, it's typically one position. Now, I would normally do this maybe with an ETF. You could do it with a stock if you wanted to. But let's just say, for example, let's use the SPY again. Okay, so let's say we're trading the SPY, we get into SPY, we go ahead, we buy, let's just say 10 shares to start. Okay, this kind of is just a starting point right here. Okay, so we got filled on our 10 shares, and now you can see we have 10 shares on the SPY right here. So those are our 10 shares right there on the SPY. Okay, now as you start looking at charts and as you look at the SPY itself, you could see right now we're kind of moving to the upside. So now what you could do is wait a week, wait 2 weeks, wait 5 weeks. Depending on your position, you could say, okay, I'm going to wait till, a little pullback, or even if it climbs higher, I'm just diversifying based on time. I could say, okay, well, my next time that I'm getting into these trades or positions, I'm going to do another same batch of quantity, but I'm doing it a month later. So this helps average your risk. Now, hopefully you get it, let's just say somewhere in the 220 area or something to that effect. Now you may say, well, won't the first 10 go down? Or the first batch of shares go down? Yes, it actually would. But remember, you're looking at a bigger picture to create a position, and that's what ultimately allows you to diversify. So you'll still be getting a dividend from the SPY. So I could say, okay, right now I've waited maybe a minute or two, and I could say, okay, I'm going to diversify and get another 10 shares or something to that effect. So that is possible. But that's not really long enough time. But here I go. Here's my next batch of 10 shares right there. Okay, and if you dig deeper into this, you could probably figure out your average price, okay, on the market. So here we did 10 shares. If you start looking into the orders right there, okay, so you could see right there I did 10 on that price and 10 on that price. So that'll help average your price down or better. So ultimately, that's what you're doing when you're doing a time-based diversification. You could do it on an individual position. You could do it on an ETF like I'm doing right here. But ultimately, the key is to diversify based on time. Of course, there are some risks that go along with it because you really don't know when is the low point. So let's say the stock pulls back right here. You don't know if that's the low point. You don't know if it continues to going down lower. But if you have the long-term view in mind and you're looking to capitalize from dividends and continue to invest and then getting those bounces, ultimately that would be the plan. Is on major pullbacks, you put in another 10 shares, and maybe within a year or two, you get into your big position of, let's just say, maybe 500, 1,000 shares, depending on your account size, obviously. So you would ramp that up with time. Now, of course, just looking at what I'm doing right here, this is an ETF-based investment or diversification. So if you look down right here on our sheet, we already did the time-based. Now, if we look at the ETF-based, now the ETF-based is pretty much what we're doing right now. This is an ETF. The SPY is an ETF. The Exxon or the TLT bonds is kind of an ETF. You also have other ETFs like the Dow Jones, which is the basket of the 30 stocks, but you also have like the IWM. So all these are ETFs. If you're just getting started, sticking to the SPY or the IWM or even the EEM, the emerging markets, these are all ETFs. So you could just say, hey, my diversification is simply just getting the Dow Jones, and that is it. And this is just a basket of 30 stocks, and you're looking at the Dow Jones. Now, for me, if I was an investor and I was just getting started and I just want to put my money all in one spot, I would just put it in the SPY and just let it sit and forget about it kind of thing. Because that's more 500-based stocks. You could do the IWM as well. This is more 3,000, 2,000 stock ETF, so it's a bigger range of stocks. But the SPY, based on the dividends that they pay, I kind of like that stability personally. But since this has a lot of different holdings in it, it allows you to be diversified based on the holdings. Now, you're still, when you're buying this, you're still basically looking for market movement to the upside. So it's still a one position. You could use this hedge, as we talked about earlier, with the GLD or the TLT, something like that, and that would diversify you. But the SPY itself is an ETF, which allows more diversification if you want just one single holding. And I know that for some people, if they're having a small account, diversification can be a little more difficult. So if you have an account of $5,000, it's a little more difficult to diversify because now you're splitting your assets and you're splitting the amount invested. So typically this is a little better for people with smaller accounts, depending on your account size. Now you could still diversify 50-50 even with a $5,000 account. It's just that the absolute dollar value, is still only $2,500 in the stock market. And that's not a big amount of money in the market. Now, the relative value to you personally, it's quite a bit of money, because we could still use it for a lot of different things. And when you diversify a $5,000 account, that's still 50-50%. So the diversification on the level of percentage of hedging is still quite big, because if one of them goes down in a big way, the other one should help and compensate. So relative to your account, in a relative basis, it's still a big diversification because you're diversifying based on 50% if you did, 2 ETFs. But here on the SPY, if you just didn't have the account or the flexibility, the amount of money or capital in there, you could just do the SPY and you should be okay there to start. So if we go here on the Spider's website, you could see here, based on the ticker, the SPY, it tells you all the different breakdowns, and it tells you fund characteristics, the yields, index characteristics, and so on and so forth. So there's a lot of things that it'll tell you about it, but it'll also tell you about the holdings. So the weight of the holdings. So you can see Apple right here is basically about 3% of the holdings and the shares held. Okay, Microsoft, ExxonMobil, Johnson & Johnson. So you can see it's a mix of a lot of different holdings here. And it gives you a range for that diversification. It also tells you here's the charts, the graphs, and you can see all those different things. So that's another way to be diversified. Now, looking at our sheet, the last few that we have is stocks and options, so such as selling calls, option strike prices, and option strategies. So here, if I look at my positions, we already have the SPY position on there. So if I look at the risk profile graph, and this will just give you a little bit of insight here. Okay, so it just basically tells you the movement, the profit or loss here on this position. Okay, so right now we're down about $70. But here, if you look at the axes, this is the price, the strike price of the equity. So right now we're at 223. Okay, so that's our current price right there. Okay, that's where we are. You can see as this moves to the upside, we make money. As this moves to the downside, we lose money. Here is our zero line. This is the money line right here. So on the left axis right here is positive $1,000, positive $500, or then you start getting into the negative value. So in either case, that's how this line works. But here, what you can do is you can hedge a position by selling some, let's say, upside calls. So if you don't think this is going to go too much higher, what I could do is, let's say, open up some strike prices, let's say maybe 25 strike prices. And I could say, okay, I'm going to sell an upside call right here and just say, sell a single. Now, in order to do this, okay, you typically need about 100 shares, okay, because one contract is based on 100 shares. But you can see what this contract alone allows me to do. So if I just look at this individual contract, the white line is our current line today, the green line is at expiration. Now, if you don't know too much about options, you might want to review some things on some of the basic videos that I have. But this is ultimately right here, when you look at it, how this is working and running is that with time, you make this extra $1.39. Okay, let's make sure everything is reset to 0 here. Okay, and okay, so everything I reset to 0 made it a live price. And now what you can see is that if we hold this position and it doesn't move, we make $84. You could see that right over there, okay, which is also the top of this green line. Okay, now as I move my mouse, you can see that right here, this white line with time, as I shift the date, gets closer and closer to the green line. Okay, the white line is our current line, the green line is at expiration. So we have a few days remaining in the January positions, about 36 days. Okay, so if this holds, we collect $84. Now, in order to do this, okay, we typically want to make sure we have 100 shares. Otherwise, we get this huge drop-off effect right there, which eventually leads to a huge negative or unlimited loss there, which is a little bit unlikely with the SPY or the ETF. But what we want to do is go ahead and buy more shares here. So we'll go ahead and buy 80 more. Okay, so as we have 80 more, now we have a full 100 shares, which you can see right there. So now what we can do to compensate for this is sell a single vertical, or sell a single call option right up there. So that means, you know, if it goes down to, let's say, 220, I lose 650, versus if I just had it without that single call, I would lose 730. And that is simply because this $84 that I'm compensating and making, okay? So if you look at this, and you notice that, okay, right now at 220, we would be losing $730. But if I add that in at 220, I'd only lose $635. And that is because of this $84 that I'm making on this spread. So you're basically selling additional premium contracts and insurance in a simple way to help diversify your position in case of the downside move. Now, the opposite is also happening. It's also limiting your upside potential. So if you get an explosion to the, let's say, 240, you'll only make 532. Whereas if you just held on to it, you would make 1,265. So you would make a lot more if you held on to it, but you have that risk. So you can diversify it in that way. Do stocks and things like that explode to the upside all the time? No, not really. Maybe if you did this, let's say 12 months, every single month selling these upside calls, you know, maybe you would get stopped out and you would lose your 100 shares within, you know, 1 month out of the 12, depending on how far out you put them. But in either case, you know, imagine doing this after you had a massive run up and then you sell one or two of these contracts. Market probably will pull back with time. So that's another hedging strategy for you. Now, one of the other ways to hedge is just the way that we did with options, is that when you have a hedging strategy like this, is you could do it based on strike prices. So what I could do is, let's say, hedging based on various strike prices. So what I could do here is, let's say I sell a vertical over on this side. Okay, so this would be one of the strike prices. Okay, and I could go ahead and wait a week or 2 weeks or 3 weeks and put on another one, maybe at a different strike price. But let's just say you get filled on this one right here. Okay, so I'm filled in there. And then you do another one, okay, maybe a week later, and that's a time-based hedge. But if things go down, you could shift it in the strike prices. So let's say you did another one at a different strike price, or even did it on the call side or something to that effect, and sold another vertical. So now all of a sudden you're creating flexible strategies, that allows you to hedge in multiple directions. So here again, now I'm hedging on the call side and added a vertical on the call side. So let's see if we get filled on this order. And go ahead and cancel and replace. There we go, we got filled. So now I've hedged simply by putting on multiple strike prices at different points. So I did the puts over here, I did the calls over here. So you can see there's my puts, sold a vertical, and then to make it red, there's my calls. So you could see that now I've kind of created this little hedge right there for downside moves, for upside moves. So again, this is based on strike prices. And I could, if things go down a little bit, I could hedge again and add a few more contracts, let's say, on this side. Or if things go up, I could add more contracts on this side. It just depends, but you can move and mix and match at different positions for your contracts. And then finally, the last strategy for diversifying and hedging, again, an option strategy, is simply what you could do is go ahead and put on a different position. So here we have on Iron Condor, in theory, 2 verticals. It's a skewed Iron Condor. You could go ahead and, let's say, put on an Amazon calendar now. So rather than an Iron Condor, you could do an Amazon calendar. Again, if you're a little confused with options, you'll probably need to just go back and just do some more studying regarding options. But in general, when you start stacking these different positions, okay, so let me go ahead and put this on. Where's the Amazon price? Okay, we're over here. So let's say I go to maybe 770. Go ahead and fill that order right there. Let's see if we'll get filled. Cancel and replace. bump it up just to get filled so you could see what's going on. Okay, so now I've stacked two different positions. I have an Amazon position, and then I also have, if I do the portfolio, okay, let's remove some of these simulated trades. So hide simulations. So now I have a SPY position and an Amazon position. So you could see as I turn on and turn off, you can see what position has the most weight. Okay, but what I could do is constantly add to these positions. And for example, let's just say I did the SPX position, okay, which is similar to the SPY, but again, I'm putting on just a slightly different kind of position, right? So let's just say now I'll do another Iron Condor just to show you just different positions. Okay, let me analyze this trade. We'll hide the positions and just show the simulations. And now make it a live price. On the put side, I want to go down to, let's just say 2,000, because this is a, you know, a multi-thousand stock, so it doesn't trade. You gotta move the strike prices in a big way. And now let's see where we're at. Okay, current price is 2267. Okay, so we need to definitely go much higher here on our strike prices. So there we have that one, and we can go ahead and tighten the put side up a little bit. Let's say something like along the lines of that, maybe a little more on the call side. So there we go. And let's just say we do 2 contracts here. Go ahead, fill that order. We got filled. So now we hide the simulations, we show the portfolio. So you can see we're creating kind of a weird portfolio graph, but here we have Amazon, the SPX, and the SPY. So as I pretty much look at these 3 positions, here's our big picture, which I'm hedging and diversifying based on positions, but I could take Amazon on and off, and you can see what that does. I could take the SPX on and off, and you can see what that also does. And you know, I could do the same thing for the SPY. So you could see they're all affected slightly differently. But those ultimately are the different ways to hedge or really manage the risks when it comes to diversifying within your positions. And remember, diversification, the simple baseline to diversification is really most people think of positions. But you could have diversification based on inverse positions, based on time, ETF, stocks and options, mixing those together. Of course, there's more strategies and variations than I shared. Then you can do strike prices and, of course, the different types of strategies within options. But for many people, and the textbook definitions is they look at positions, but that's not the only way. So look at a few other variations, because the goal is really to manage and reduce your risk. If you ultimately reduce your risk, then that's the whole point behind diversifying, is that when things go against you, when things don't move the way that they should for you in the direction that you have positioned, the downside problem or the problem going in the opposite direction isn't as bad, and it doesn't hurt you as bad. So remember that when it comes to diversification. There's more than one way than just putting on and stacking more positions, but that's ultimately how you do it. Thanks for watching this video on diversification. I hope you enjoyed it, because there's a lot of different ways to hedge and minimize your risk. Now, one of the new things that I'm doing here coming up is we'll be doing more and more live classes as we continue further on into the year of 2017. And if you want to participate in some of those live classes and live trainings where you can ask me questions directly, where we can interact, even go video to video and just chat about different topics and subjects, and I can share my screen with you, then make sure you sign up to the newsletter list by clicking the button right over here. And when you click that button, sign up and get on the newsletter list, because that's where I'll share with you the private links to where you can get on some free live training classes. Now, if you want to continue watching some other free training videos here on YouTube, then just simply click this thumbnail and you'll continue watching other training video lessons. In the end, remember, do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.